Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Tuesday, April 15th, 2025. Today's episode, I'm actually going to start with the second headline to get it out of the way. Mr. Market waits for the other shoe to drop. Limbo presides. Not much moved in markets. I found there to be a few interesting developments, but overall, Mr. Market is waiting for the other shoe to drop. On to our main headline of today, because there's not a lot to talk about in the markets, especially. I wanted to talk about gold again. I've talked about it many times before. The headline being gold is expensive. Here's a way you've never measured it. Besides the fact that if you bought gold in 1980, the January 1980, you wouldn't have seen that same price for 28 years. Similarly, in 2011, you wouldn't have seen the same price level for 9 years. Besides acknowledging that the price of gold can and does frequently drop by 40%, and besides the fact that the bond market is not pricing nearly as much inflation as gold is, this gold line representing gold diverging from the tips market, highly unusual. And besides the fact that copper has never been cheaper, basically, to gold. Granted, it's not really fair to look before 1970 since we got off of the gold standard, but even when zooming in, looking at the beginning of this chart at 1978 until today, you can see we're at the very bottom range. Besides the fact that, well, let's do this one, home prices have never been more expensive, costing Americans earning a median income having to work for 7 years to be able to buy a house. Their total income for 7 years is what it takes to buy a house. Besides that, home prices have never been higher in history. Add to that gold has never been more expensive relative to housing in history. We're at the very bottom of this chart here. Besides all of those things, I wanted to add one more piece to the gold might be overvalued category. And here it is, a decade by decade comparison of the price of gold to the amount of dollars basically that exist in the form of M2 money supply. Specifically, the numbers I want to take a stronger look at are over here. Gold market cap as a percent of M2 money supply. So what we do is we take the above ground gold, the amount of gold that people have mined out of the ground. You have the entire value of all of that gold in trillions of dollars, which is found by multiplying the amount of gold by the current gold price of these various years. And you compare that to the total M2 money supply of the United States, and you get this percentage over here. So when the percentage is high, it means that gold is a little more expensive than normal, and when it's low, it's a little more cheaper than usual. And as you can see from this chart, before 1971, before we got off the gold standard, believe it or not, gold as a market cap to M2 money supply went from 82%. So all of the gold in existence was worth 82% of the total amount of dollars in existence. In 1934, it represented 124% of all the gold that existed. And then 1945, 67%, 1971, 25%, 1980, where that peak was, where we showed before, it got to 145%. This is right before gold had not seen that same price of $614 for 28 years. And then in 2000, gold became pretty obviously cheap, being at a historic low level, only 28% of M2 money supply, only rivaling previously with the 1971 price. And then in 2010, 76%, 2020, 61%, and now we're in 2025, where gold represents essentially 100% of M2 money supply. I'm not saying that we are at the exact highest ranges that we've seen throughout history, but we are certainly not low. The big danger with buying something at an obviously high price is the downside risk, the potential that you might not find someone to buy that gold from you for a higher price for potentially a pretty long time. Community topics. What moves, if any, did you make today? I share with you what I'm doing, and I love hearing what you guys are doing, and you can share with each other what you're doing in the comment section below. One thing that I did today was I actually sold one of the few stock holdings that I have, OTGLY. This is CD Projekt Red. I honestly bought it not because it fits Benjamin Graham's ideas, but because I just really liked the company, and I got in cheap enough to make a handsome reward on it, and I don't know what the risks are. I still like the company and everything. I think it's well managed. I think they have a lot of good things. I think Warren Buffett and Charlie Munger, for example, might be a fan of this, but it doesn't exactly fit my idea of buying something that's obviously cheap in order to wait for it to get to a normal price or higher. So I sold it. So that's what I did today. What did you do? Comment below. Still coming up, waiting for the next shoe to drop. Continuous tariff updates. I'm pretty sure this isn't over. And then later this week, we have initial jobless claims coming out Thursday. I'm thinking with markets rocking around like this, CEOs are looking at the stock prices of their companies go crazy, and they realize there's a bit more risk going on. Unfortunately, I think that we may see potentially this week uptick in the initial jobless claims over fear of slowdown. There certainly is a lot of fear out there. The future for everyone's crystal ball right now is seeming kind of murky. So Thursday might give us some clues as to what we may see further. Before we get to the charts, thanks for watching, subscribing, commenting, and supporting. Recently got a very nice donation. Thank you very much. You know who you are. There have been some updates in the daily reminders written here and explained in previous videos, but for the majority of this, you can still watch Macro Update to 1125 to hear me explain my understanding of what's going on in markets. These are my macro views in a nutshell, and tell me that we are headed into a recession or a depression right now. No major changes in the crystal ball readings either, or the Robschild portfolio, besides getting rid of that one stock that I mentioned earlier. Watch portfolio update to 1125 to hear me explain all that. On to the charts, starting with the SPX S&P 500, closing a whopping 0.17% down today. You have to chuckle a little bit at this just because of how much extreme volatility that we've seen in the markets, and this is why I'm saying the market is like finally in like sitting on my hands mode, waiting for the next shoe to drop. Similar to yesterday, the VIX is still elevated here. This is not a low VIX. When option contracts are getting cheaper, that's the market saying, okay, we're back to boring, march our way higher until some other thing happens. Right now, the VIX is saying a little bit like, okay, we're still in chaos mode actually here. 30 is, although lower than what we've seen very previously, getting all the way up to 60. This is nothing to cheer about. I need to see the VIX drop below 20 before I'm convinced that the bulls are back in control. Another piece that is convincing me that the market is very much waiting for the other shoe to drop is nobody wants to buy a barrel of crude oil right now for more than $61 a barrel. This is a lower price than we've seen for the past 3 or 4 years. This is an ominous sign that there's a high chance of us going further down from here, let's just say. One of the especially odd things about the oil market right now is that they're supposed to be pricing in summer driving, which is supposed to get oil going up, and we're not seeing that, adding to the case that there might be even more worse chaos straight ahead. This high yield corporate bond fund, junk bond fund, helps express on a minute-to-minute update as to how the market feels about credit spreads, how risky are higher risk businesses for being able to pay off their debt. We rose a little bit today, but we are not back in this super tight range that we were in previously for a long time. People lending money right now are taking a little less risk. They're saying we need a little higher payments right now to lend out to higher risky borrowers. This helps the case for the bears that the bulls might not have as many legs. They just don't here. When you have to pay more money to your debt, it takes away stockholder value. And after all of this extreme volatility in the charts, it just says there's even more risk to maybe even further downside, maybe very soon. Again, waiting for the other shoe to drop. The sky is falling, said everyone, as DXY, the dollar index, was collapsing during a time when it wasn't supposed to collapse. It at least paused here. We even had a green day, so some buyers in the dollar. Many people are still seeing this as sort of a bearish pattern, as we have a pole going down and we're consolidating at the bottom. This is typically bearish, so it looks like the dollar actually does want to go down further, but we're no longer simply falling. So there's a little bit of consolidation happening here now. I also want to bring up the 10-year Treasury note yield again. It is no longer spiking. In fact, further cooling off after yesterday's cool off in the 10-year Treasury note yield. Over the past few days, over the past few shows, I've been talking about perhaps getting into Bitcoin as we are above this previous trend line, and just by these little chart patterns here, it does appear that Bitcoin wants to go higher. However, after today, with the entire candle being in the bottom 25% with a large topping tail, the bulls tried their best to get control of this market today, and they were sold off. So, add to that with the VIX being high here, add to that credit spreads have been widening here. Overall, if there is a move in markets that is risk off, Bitcoin is unlikely to continue higher at this juncture, in my opinion. So I am not getting into Bitcoin, not right now. I wanted to bring up sector performance today, specifically 1 month, 3 month, and 6 month. And I want to note that throughout all of this volatility, the winners are coming out. The very top one being consumer defensive utilities on the 1 month, 3 month consumer defensive utilities on the 3 month, half year consumer defensive, financials somehow is in there, but then utilities as well. This to me continues to say that more and more investors are getting defensive here, and it's normal to get defensive when there seems to be chaos happening, and the market is seeing that, and the market is acting that way. All of the growth priced, all the enormous amount of growth priced into the already enormous companies and trillion-dollar market cap companies, expecting greater and greater amounts of profits, greater and greater amounts of earnings, revenue. So much has been priced into growth that it is very speculative and it is very dangerous in my book. And Mr. Market is waking up to that. As I said yesterday, to me, it's sort of saying that the market's actually getting more healthy here, is how I can describe it. And I see that as a good thing, especially considering the total market cap of speculative price priced into these mega cap companies, which is in the trillions of dollars. All of it can get wiped out. And so finally, Mr. Market is backing off a little bit, going into a little bit more defensive plays. Looking longer term, that means less of a blow up if things blow up. The more excessive speculation priced into securities, the greater the potential downfall is. I mentioned the TIPS market earlier in the show. Treasury inflation protected securities. Compare that to the 10-year Treasury note yield. You get the 10-year break-even inflation rate. This is the bond market, the humongous, very deep and liquid bond market that prices inflation to average over the next 10 years, still not high. This being the bond market, being the quote-unquote smart money out there, the smartest money out there, is not pricing inflation to average very much higher than 2%. In fact, right now today, it's 2.19%. Granted, this can and will change with further developments on things, but with all of this tariff news, I have to repeat here. People were like saying, inflation, 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 gold, inflation. But this, the break-even inflation rate, dropping, staying surprisingly low. If you only watch the TV and other people talking about tariffs and inflation and gold, and this could be something that you could easily miss. And it's a massively important metric to continue to keep an eye on. Next, I wanted to talk about the 10-year minus 3-month Treasury. If we go out to a max view of this, when it gets inverted, that means that the monetary policy is restrictive and they're trying to strangle the economy. And then once they realize they strangled it enough, we get into a recession. It's just a business cycle, guys. Nothing to be too crazy about. 2000, we strangle the economy. Oh, we did enough. Oh, there's a recession. In 2005, 2006, we're strangling the economy. Oh, we're done strangling the economy. Financial crisis. Before the COVID crash, believe it or not, we went negative. We were strangling the economy. And then COVID crash. And then we're in good times all the way to 2022. And then, boom, we have one of the deepest inversions of all time. And now we're done strangling, but sort of. And that's what I want to talk about. We can't decide if we're strangling or not anymore. We are going above zero one day, below zero the next. Is the Fed being restrictive right now or not? That's the million-dollar question. That's the question that the market has not decided yet. If the Fed is indeed still strangling the economy, after 2 years of strangling the economy, the fallout is, in my book, probably going to be even that much worse. So we can only hope that the Fed is actually done strangling the economy here. Mr. Market wants lower rates on the front end of the curve, period. And we're not getting them yet. Last chart of the day that really caught my eye was actually uranium. I'm going to scroll in. I just want to point out the power of charts. It just caught my eye so crazy today because we had this peak in let's see here, April of 2022, when uranium got to $64 a pound, I'm pretty sure it's a pound. And it's amazing. We've had very recently, after uranium going quite a bit higher, peaking around $100 a pound, dropping, and then now pausing right at this exact peak that we had before. Something that continues to astonish me, really, is just how psychological markets are and how these trend lines and price points that people have experienced, they rode it up to 64 and it sold off and it didn't get back up to that price for years later, and then we went way above it and now we're like, oh, I wish I got in at that price because it went higher after that. And just amazing how that works. So that we're actually fighting for a while here at this exact previous top of 2022. I like to follow uranium because it's another investment opportunity when uranium gets really cheap. Uranium is, in my book, very much a part of our future. It doesn't necessarily need to go to the moon. I'm interested in it if it gets very cheap, which is why I'm always keeping an eye on it. But anyway, I digress. That's all for today. That's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.